So, Kiah, speaking of infrastructure and the surprising role that it plays in how things work, can you give us an update on the bank rescue program, which was something that we talked about last year, I believe?
We have talked about this. Its formal name is the Bank Term Funding Program, but I like to think of it as a not discount window. And that's because it is the Federal Reserve's emergency liquidity facility. It was set up after the liquidity crisis that was kind of kicked off with SVB because very specifically, the concern was if uninsured depositors started pulling their money out of banks everywhere, there wouldn't be enough lending capacity from the FHLB, which is many banks' preferred secondary liquidity provider. And to incentivize banks to use this not discount window, they the Fed allows you to doesn't make you take the discount on your securities that have lost value. So the funding is done collateral at par value instead of the discount value. So it's actually like a pretty it should be more financially attractive from the collateral perspective. And the reason why it's coming up now is one, it's within 3 months of its targeted end date. This was a 1-year liquidity program, but also the market has priced in that long-term interest rates are going to be lower than they currently are, which is presenting like a nice arbitrage opportunity for banks to make a little money with a pretty risk-free borrow from the Fed at I think it's 4.7 today, and then put it into your reserve account also at the Fed at 5.4. And these are kind of decision, or like the 4.7, that's a market-based rate. That's why this arbitrage exists, because, the Fed is successfully indicating and people believe that long-term rates will be lower a year from today. And so banks are kind of taking advantage of that. That discrepancy and borrowing from this discount window before it winds down. And, that's probably not what it was intended for. But I think it's fine that banks are doing this. I think it's fine to make a little risk-free money. Banks are not making a lot of money right now. And also I think it's good that banks use this facility, especially because many of the things that led to SVB needing to restructure their balance sheet actually still exists. Whether or not we have that liquidity urgency, still, I think banks still need a lot of different funding sources, and I think it's good, to incentivize them to borrow from the Fed rather than from the FHLB as emergency backup liquidity. What about you? I mean, do you like this trade?
It's a good, risk-free, always take risk-free money, right? I agree. The Wall Street Journal headline was the Fed launched a bank rescue program last year. Now banks are gaming it. And, it's a good headline, but I agree. I don't think there's anything super unusual or all that bad necessarily. And I like that you mentioned the non-discount window, discount window way of framing it, because as we talked about, I think last year when SVB and everything was going down and we were talking about what are the sort of emergency liquidity sources that banks can turn to when they need it, there is this very strange reluctance to lean on the Fed discount window, right? And part of it is, as you were saying, the collateral. Part of it is just it's like a bad reputational thing, right? It's seen as like literally the lender of last resort. And, if you're using the lender of last resort, then you must really be in trouble. And so it has this weird stigma, which you've talked about a lot on the podcast, that probably shouldn't exist because, these things are designed to be used when you need them. That's the whole point.
Yeah.
But it still does exist. And so I kind of wonder, more psychologically, almost from a bank and investor perspective, if this might be a helpful bridge to kind of helping everyone in the industry remember these things from the Fed are designed to be used, and it's not a sign of imminent doom if someone taps into these when the environment is appropriate, right? I kind of think of it, to your point, what the sort of consumer equivalent is. It's kind of odd because all of this stuff is coming from the Fed, right? And so it'd be if my bank is paying me 5% on my savings account, but then they're also just giving out money at a lower interest rate that I can borrow from. Like, that would be a weird thing for my bank to do, but no one would blame me for taking advantage of that trade. And I think that, just like the use of these facilities generally feels like something that we need to normalize and kind of get back to a better balance on. Because, the other thing I did not know before SVB melted to the ground last year was that, like, the federal home loan banks play like a shockingly important role in backstopping a lot of the liquidity in the banking space. And, like, as you and I have talked about before, it's not exactly what they were designed to do, and they don't work perfectly really for everyone under any circumstance. Right. Like, it's a the degree to which they were using those almost exclusively was a misuse of what it was set up for. So I'm all for like, let's kind of diversify the options here a bit.
And I hope that, concurrent to the bank term funding program, non-discount window, the Fed actually has spoken, governors have spoken about banks using the discount window and saying, we believe that this is an important part of secondary liquidity. And, SVB famously wasn't connected to the discount window when they had their deposit run. And so I'm hoping that, if you're a bank that's taking part of this trade, that actually does help you test your capacity to borrow from the discount window. It makes you put collateral at the Fed and use it as a facility. So I do think, like, again, I kind of don't think the BFTP should go away. I don't think it should go away for as long as the rates are really high and as long as we're dealing with this AOCI liquidity situation. I don't think there's anything wrong with, for banks making a little bit of money off of the difference of these rates. But I do think that if the BFTP goes away, do banks go, move all of that borrowing back to the FHLB, or have we successfully gotten rid of or lessened the stigma of borrowing from the discount window, and now you'll just move to the discount window? And we know that, like, during the financial crisis, there were times that the FHLBs had higher rates than discount borrowing rates, and banks still used them instead of using the discount window. So this is a pretty strong stigma. Price can't just erase it. So I'm hoping that, this is, I think the BFCP really helps stabilize the industry, really backs up, also remove pressure from the funding constraints of the FHLB. And then, I just don't think we're in such a radically different operating environment from March, 8th, 2023.
Yeah. No, I agree with that entirely. And it is weird how these things will, like, go from being a crisis, we have to have this, we have to set this up, it'll be ready next week, blah, blah, blah. And then, like, just with, like, not even a full year removed, we're like, we don't need this. And the conversation totally shifts to, like, one, like, not only is it over, but, like, banks are gaming this, right? And I don't, I'm sort of mad. The more I'm thinking about this, the more I, like, am getting mad at whoever wrote that title for the Wall Street Journal article. Cause, like, the problem with that framing is, it sort of positions this funding mechanism the same way that, like, the FDIC's charter for its insurance fund is written, right? Which is like, we don't lose money, right? And, like, there's something sort of vaguely annoying about regulation for banks that prioritizes taxpayers not losing money over safety and soundness, right? Or maybe possibly at the expense of safety and soundness. And I feel like when we say, well, they're gaming this, it's like, well, they're sticking their hands into the pockets of taxpayers, taking money out and just, like, laughing all to the way the bank. And, like, that's not really true, right? And to the extent that it is, to the extent that it's, like, kind of true, it's a trade that I, as a taxpayer, am more than happy to make if it reduces the odds of these, like, liquidity crises in the futures. Like, those things are way more expensive and disruptive to me as a taxpayer than whatever incremental pennies I'm chipping in to make sure that banks have, like, adequate liquidity right now. So that whole framing kind of annoys me.